It's fairly obvious that the U.S. economy in recent years has suffered something of a cancerous bloat of an overgrown financial sector. Now, a lot of people have failed to notice that trade played a big role in this, or free trade. What it did is when we caused us to run a trade deficit around $500 billion a year, it fluctuates. But what you're looking at is the backwash of all our imports is that we had a flood of cheap foreign capital into the United States. This is capital that was artificially sent to the United States to buy our debt, to buy up our existing assets, because foreign nations weren't getting goods in return for their exports to us. So they have to get something. So what they get is they get claims on Americans in the form of debt, and they get claims to our existing assets, be it shares of corporate stock, real estate, or whatever. Now, as a result of this very artificial flow of capital, which was artificially pushed, make no mistake, this is not a free market outcome, artificially pushed by governments like China, Japan, and some others, you have a flood of capital in the United States which really shouldn't have been there. And when you have capital doing that, it starts looking for love in all the wrong places. So that was a major contributing cause to asset bubbles in the United States and to the general bloat of our financial sector at the expense of other sectors of our economy. Currency manipulation sounds like something technical and obscure. In point of fact, it isn't. It's very important because currency is money, so it determines what's profitable and what's not. So it determines what happens and what doesn't. Now, the deal is that when you have two countries with two currencies and they trade with each other, the relative price of those currencies, that is the number of dollars you get for one renminbi or vice versa, that's a Chinese currency, is set like any other price in a market economy. It's set by supply and demand. Now, the trick with currency manipulation is that the demand for dollars, for example, which determines the price of dollars, if there's a strong demand for dollars, the dollar will stay strong. That is, anything denominated in dollars will be expensive. Is that the demand for dollars is not only for dollars to buy American exports, the things the Chinese actually do buy from us, like the Boeing jetliners, like soybeans. There's also a demand for dollars to buy American financial instruments, which means debt and title to existing assets, which can be anything from skyscrapers in downtown Los Angeles to shares of Microsoft. As a result, if you have one country having a government that systematically forces its economy to purchase American debt and American assets rather than American goods, you can manipulate the relative price of the dollar and the renminbi, which makes American goods artificially expensive in China and makes Chinese goods artificially expensive in the US. Now, this is the reason why our trade with China doesn't automatically reach a balance. If it were not possible to buy debt and assets, then when the Chinese exported so much to us that they ran a huge trade surplus as they do, that would drive down the value of the dollar. American goods would become cheaper and cheaper over there. Their goods would become more and more expensive over here. Eventually the two cross over and we get balanced trade. That is, no trade deficit. Our exports to them equal their exports to us and vice versa. The problem is when you have the systematic currency manipulation, and there's no secret how they do it. In China, when you earn dollars by exporting to the US, you're not allowed to spend them on whatever you want. You have to take them to a government-controlled bank and swap them for Chinese currency. So you get your money and you get to be rich, but you don't get to throw them around any way you like in the international economy. And the Chinese banks, they take that money under government direction and they buy American financial instruments. A lot of it is simply T-bills. China has a voracious appetite for American T-bills, our own government securities. So as a result of this, the US dollar is artificially strong. Our trade with them stays out of balance. And we've been trying to get them to stop doing this.